You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right. Well, what a fun week to be trading options. We've had some volatility in the marketplace for the first time in a while. We saw the VIX index run up as high as almost get to 30, just shy of that, right around the 28 level. And because of that, everybody thought the sky was falling. And lo and behold, we turn around and the market just comes right back, roaring back. But we still have the VIX trading right around the 20% level. So we're still a little bit elevated on the current VIX. And then if we go out and we look at the futures contracts, they've spiked in the December and November, all the way up to the 25, 26 level. And now they're back down a little bit, hanging around the 24 level. Okay, so let's take advantage of a little bit of volatility. I'm trying to think how I might address this on the midday market call, which we do on the Ally Zoom platform. We looked at a short VIX call spread, actually sold a little bit in the money relative to the futures contract. And so we were looking for the market to go down on the VIX on that trade. I think we went out about 10 days or so. So I don't necessarily want to go back and do that. That trade is I liked it better when the VIX was closer to, I think it was around the 26 handle level. Now that it has came off after a rally, I still like the increased volatility. This is the time I'd rather trade with the VIX at 20 than trade with the VIX at 10. So I'd rather have a little bit more volatility than that's comfortable, as opposed to not enough volatility overall. So I'm going to look at a trade that's going to be in the S&P 500 index. And as always, on Options Playbook Radio, it's not meant to be a recommendation. We're going to do a two-step trade. It's going to be a very short-term trade. And the reason why we can do this trade is that the volatility is high. And if we didn't have the VIX up around that 20 level, which the VIX is based off of the S&P 500 index options, if you did not know. So because of that, we are able to do just a very short-term trade. So on this instance, the markets are closed. It is Wednesday, September 22nd. We have the S&P 500 index today trading at $4,395.64. It was up $41.40 $41 on oh, I'm sorry, $41.45 on the day. We currently have the VIX index still hanging around the 20% level. It was down $3.49 on the day, but it's still hanging out at the 2087 level. Now, I'm going to do a trade because I really don't have any idea what's going to happen in the marketplace over the next 2 days. A lot of people on the downturn were calling for the doom and gloom going into the end of September at least, a little bit more of a sell-off before we would ever get our bounce back. Unfortunately, in a weird way, not a lot of people even got the opportunity to buy the dip because the dip already went away overall. Okay, so we're going to use calls on this trade, and we're going to do a long call spread where we're going to sell an at-the-money call option, meaning that we are going to be selling more time than we are buying. So this ideally is even a neutral to bullish strategy, which a lot of people would think of short call spreads overall, but neutral to bearish in that instance. So we're going to go out and look at a neutral to bullish strategy using long calls. We are then going to already talk about the adjustment. This trade is only going to last for 2 days. You have all day Thursday, all day Friday before that expiration date. And with the markets it's really close to 43.95. We're going to sell the 43.95 call. And then we're going to go 10 points wide, and we're going to buy the 43.85 call. We're going to get this done for a net debit of $6.10 to the account. What we would like to happen is by Friday, we would like the market to be above 43.95. Guess what? It's above it right now. It's 43.95.64. So it's 64 cents in the money for our long call spread, which is a total of 10 points wide. Total risk would be that net debit if we could fill at the midpoint of $6.10 or $610 plus commission on that trade. Okay, that means that we're doing a neutral trade where we're doing a bullish trade where we really don't mind if the market just kind of stays where it's at. As a matter of fact, we still have a lot of upside. And once again, this has a lot to do with the way the volatility is playing out, the reason why we're going to have this risk reward ratio. But we're going to have $3.90 worth of upside. And we'll have $6.10 worth of downside. The maximum this could trade for would be $10, which is the width of the spread. $10 minus $6.10 is $3.90 minus commissions. So if we put this trade on and the market opens down tomorrow, now we're up 41 on the day and we just meandered up all day long. On the open, I do have an adjusting trade. And once again, part of the reason why we can do this trade and have basically paying $6 for the potential to make 4 is because implied volatilities are high. And when you do this, when you have high implied volatilities, it makes adjustments easier overall too. Normally, we would probably have to go out a week to get enough time premium to have this type of risk reward by selling that at the money option contract and then creating a 10-point wide long spread. So if on the open tomorrow, we are down approximately 10 points, I want to roll this into a butterfly. And the way that I can look at this and get a guesstimate as to what that butterfly may be trading for is you just shift things a little bit and you look at, well, where is the at the money short call spread now? So for example, to make this a butterfly, we would go on out and we would have to sell another of the 43.95 calls and then we go up 10 more points, keep the wings equidistant, and buy the 44.05 calls, 44.05 calls. If we did that, we would bring in a net credit of $5.45 to the account, making this entire butterfly 65 cents, which overall isn't really that bad of a trade if you just wanted to start out with a butterfly. But I think I want to go this direction. We got some momentum in the marketplace that has driven us forward. We want to be a little bit more bullish than we would if we just did a butterfly. And then I'm going to adjust it. So if the market opened up down 10 to 15 points, if it was down 10, I would expect that credit spread that we're selling, the 43.95, 44.05, to be trading right around the $4.50 range. Okay, so about $1 cheaper than it is right now. Now, it would be a fairly expensive butterfly to put on, but this would be a trade that would be, okay, the momentum is going against us. I don't want the cheese anymore. Just let me out of the trap. If I sell that credit spread, roll into that butterfly after it's moved against me, I still have a toe in the water. I could still be looking for the market to come back. I'd still like it to come back to that 43.95 level. But I'm going to bring in a very good size credit to have a couple more days to see if my trade actually pulls out and it lands somewhere in between my long strikes. So this is a very simple trade that if the market goes with us, if we put on this long call spread and the market goes up tomorrow, well, after 1 day's worth of time decay, we're going to be looking pretty strong. And then if it rallied like it did today, up 40 points, you'd probably ride it all the way to expiration. And one of the most wonderful things about the S&P 500 index is that it's cash settled. Basically, they just put cash in your account if you are correct. And if you are incorrect, they'll just take cash out of your account overall. So it's you're not dealing with stock. You're not worried about exercise and assignment. And this, to me, makes it a more superior product than the most popular trading vehicle out there, which is possibly the SPY, which is the ETF that tracks the S&P 500 index overall. But that settles in stock, and you got to worry about dealing with stock. I'd much rather just deal with cash, especially when I'm doing a strategy like this on a very short-term basis overall. All right, so let's rehash this trade. If we were looking to do this trade, it is Wednesday. Markets are closed. We see the S&P 500 index at 43.9564, $4,395.64. It is up $41.45 on the day. We are going to buy to open the 43.85 call, and then sell to open the 43.95 call. We're paying a net debit of $6.10 for the account, or for this 1-by-1 spread. And if we could fill it to midpoint, that would mean that we would have $610 worth of risk on the trade, but we'd have $3.90 worth of upside on the trade, maximum that we could make on it. We're going to put the trade on. And if the market does go against us, we have one trade that we are going to adjust with. If the market goes down 10 points to 15 points on the open, I do want to act quickly. And I want to sell another of the 43.95 calls and then adjust it by buying the 44.05 calls. Now, I did have a question this week that came into the options guy at invest.ally.com and asked, well, what do you do if the market comes roaring back and skyrockets through your current butterfly? And my response to that question is absolutely nothing. I'm going to try to make this adjustment. I'm going to do one adjustment in it, and I'm going to hope that it lands somewhere near my short strike And if it does come back and does hang out in that range, and I can basically get my money back or make a small gain, I'm going to get out of the trade. I'm not doing the hedge trade to try to hit a home run, because trying to guess exactly where the S&P 500 index is going to close on a 10-point wide butterfly. Now, you can have there's a lot more room for error if you're looking at a 20-point wide butterfly in the S&P 500 index, but on a 10-point wide one, you only have a 20-point range overall. And the market today, moved 41 points. So when I talk about these trades, and I've talked about them before, this is probably, everybody by this time probably knows I do like butterflies. And I also like to look at, start with a butterfly and roll into a short spread, or start with a long spread and roll into a butterfly. But I really don't want to overtrade on these positions. I might be more tempted to adjust it if it was a 3-week long trade. But I usually don't set up any butterflies or anything that long. That's just so much time premium in a underlying like the SPX. Maybe I would consider it in the SPY on a one contract basis, but in the SPX, I really don't want to do a butterfly, a speculative butterfly like this, and go out 30 or 60 or 90 days in time overall. Okay. So that's the whole trade for you there. And if we do it, when we adjust that trade, we're hoping to lower our cost. Our total risk right now is $6.10. I would like to basically have $2 on the table. In other words, I want to sell that credit spread for around $4. If I can get a little bit more for it, that's fine. But I'm choosing when I'm going to sell it. You're usually not going to get a big gap down on the open. It might move quickly, but it's not like an underlying stock. This is an index. We're talking about 500 stocks in the index overall, so you should have time to adjust it in general. Most of the time, you're not going to get that ginormous gap down or gap up on the open in the S&P 500 index. It's possible, but most of the time you do not. Okay, so last week, kind of changed things up here a little bit. We looked at Coinbase, and we actually did a skip strike butterfly in Coinbase. And thankfully so we did, because that is the one thing that has gotten beaten up is Coinbase. And not only has it got, I should say the cryptocurrencies. And interesting enough, Coinbase has actually been grouped in, it seems like, with cryptocurrencies. And even though it's an exchange, and the more volatile the markets are, the better the exchange does, it has a tendency to trade right alongside with the cryptocurrencies. So over this 5-day period, we are down a little bit since last week on Coinbase. Coinbase last week was at 247.07. And we now currently see Coinbase trading at 241.62. Over the 5-day period, it did run all the way down to about 232. But this is one of the wonderful things about a skip strike butterfly is there's no reason to panic. We looked at doing the 265 September 24th expiration, which means it still has 2 days to live. 270, we skipped the 275 and did the 280. We did it for about a net credit of 10 cents if we could have filled at the midpoint. And obviously we were on the close last week. And guess what? All these options are trading for nothing now. You made 10 cents if you did nothing on that trade overall. And that's part of the reason why you would do something like a skip strike trade here, looking for a little bit of a bounce up. Did a very short term so that you could get rewarded if your forecast was correct. It wasn't. Market went down, but no reason to get out of the trade because you already have a hedge built into it in a skip strike butterfly. So even when we were totally wrong about direction, the trade turned out, you could say it's profitable, but ideally commissions probably took it away. So you at least broke even on that trade overall. All right. Well, I hoped you could follow all that. You might have to rewind a little bit. I tried to talk a little slower. That's some of the feedback that I've received on this. But we're looking at a long call spread. And if the market goes against us, we're going to adjust that trade by selling a short call spread and making this a very short-term butterfly in the S&P 500 index. And we'll come back next week and we'll look at that trade and see how it all worked out. So that's it for this episode of Options Playbook Radio. If you have a question you'd like to send me, please do so at theoptionsguy@invest.ally.com. Please follow me on Twitter. We have a lot of educational events over at Ally Invest, particularly on our Ally YouTube channel, which you can just do a search for that. Every Tuesday, we do the stock play of the day. If you'd want to join in and actually watch some video and talk a little bit about a stock and a little bit about a paper trade for that week in that underlying stock. And if you'd like to know more about it, you can just email me or follow me on Twitter. Like I said, we tweet about all those events. And then thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.